In Chapter 11, we are going to talk about exotic options. Exotic options include any options which are not American or European call or put options. Exotic options traditionally were less frequently traded and were less liquid than European and American call and put options. However, nowadays, a lot of the exotic options are actually very frequently used and are very liquid. So in that sense, they're not as exotic anymore. Nevertheless, we still call them exotic options. The first type of exotic options we look at are non-path dependent options. Non-path dependent means that the final payoff of the option is some function of the underlying asset at the maturity date, capital T, and therefore it does not depend on the price of the underlying asset prior to the maturity date, or in particular it doesn't depend on the path of the underlying asset price during the lifetime of that option. By the fundamental theorem of asset pricing, we then know that the price of the option at time small t prior to the maturity date capital T is equal to the final payoff at the maturity date of that option discounted by the risk-free rate and taking the expectation under the risk-neutral probability measure Q. Now, if we have the Black-Scholes assumption, so meaning that risk-free rate is constant and volatility is constant, then actually turns out that for many exotic options, we can derive closed form solutions similar to like what we did for the European options with the Black-Scholes formula. Now, for certain model assumptions, if interest rates are not constant and volatilities are not constants, then we need to resort to Monte Carlo simulations, or also for certain exotic options where it's just not possible to find a closed form solution even if interest rates are constant and volatilities are constant, then we can always resort to Monte Carlo simulations. Again, in Monte Carlo simulations, we have seen that in Chapter 10, basically simulate possible realizations of the underlying asset, interest rate, and therefore that payoff of that option which you look at. And then what you do is you discount the payoff of the option by the risk-free rate and take the average of this value over many simulated paths, and that is an approximation of the expectation in the fundamental theorem of asset pricing. The first type of non-path dependent exotic options which we look at are binary or digital options, and the first type of binary option I'm going to look at are cash or nothing options. In a cash or nothing call option, your payoff at the maturity is going to be X dollars if the price of the underlying at maturity is above the strike price and $0 otherwise. I can also write this payoff as X dollars multiplied by an indicator function, which is equal to 1 if ST is larger than K and 0 if ST is smaller than K. So this looks actually quite similar to that strike price part in a European call option, and therefore the price of that binary cash or nothing call option is going to follow exactly the same concept as what we did when we derived the European call option price. So in particular, under the Black-Scholes assumption, if interest rate and volatility are constant through time, then the cash or nothing call option price at time t is going to be equal to the present value of that dollar amount X times the probability of the option being in the money under the risk-neutral probability measure Q. So that was kind of the same thing as the strike price which you have to pay in the call option. That took exactly the same form. Now the cash or nothing put option is going to have a payoff of X dollars if the price of the underlying is less than K and 0 otherwise. Okay, so here this 1 with that subscript says again this thing is equal to 1 if S is less than K, and it is 0 if S is larger than K. Under the Black-Scholes assumption, again this thing is basically the same payoff as the first part in a European put option, where you receive strike price if the put option is in the money. So the cash or nothing put option then is just the present value of the X dollars times the probability that ST is smaller than K under the risk-neutral probability measure Q. The next thing we look at is a binary asset or nothing option. So instead of receiving X dollars, we receive the underlying asset in the asset or nothing call option if the price of the underlying is above K and zero otherwise. This thing looks now really the same as a European call option, except that you don't have to pay K dollars if you exercise your option. What's the value of that asset or nothing call option at time small t? Well, it's going to be the same as the price of the underlying asset times the probability that ST is larger than K, or that the option is in the money under the artificial probability measure Q star. So that was kind of the same thing as the first term in the Black-Scholes formula for a European call option. The asset or nothing put option has a payoff of ST dollars if the price of the underlying asset is less than K dollars at the maturity and zero otherwise. So again, under the Black-Scholes assumption, constant interest rate and constant volatility, we can again look up that term in the valuation of a European put option. That was the second part there, and the value of that asset or nothing put option now is just the price of underlying asset times the probability that the option is in the money, meaning probability that ST is smaller than K at maturity under the artificial probability measure Q star. The next binary option is the gap option, and the gap call option is going to give you the underlying asset minus XT dollars if the underlying asset price is larger than K at maturity and zero otherwise. So in that sense, it is very similar now to a European call option. The difference is that you don't pay strike price K, but you have to pay price X. And so in that sense, it is very similar to pricing as a European call option. All we need to do is replace strike price by this dollar amount X when we look at the present value of that dollar amount X in that second term. Otherwise, it's exactly the same formula as a European call option. The gap put option, here you have to deliver the underlying asset and you receive X dollars if the price of the underlying asset is less than K. Basically, this is the same as a European put option. The only difference is instead of getting K dollars, you receive X dollars. The last type of binary options which you're going to look at are the super share. A super share has a payoff of 1 divided by Y if and only if the price of the underlying asset at maturity is going to end up between K and K plus Y dollars. Notice that if Y is a very small number, so that interval between K and K plus Y becomes very tiny, or is eventually equal to just K, then this really approximates an Erre-Debreu security. So where you get a payoff if S is exactly equal to K dollars and zero otherwise. There might be some worry that there will be some manipulation if the price of the underlying asset is easy to be manipulated, meaning that if there's not a lot of trading volume and not much liquidity, so then a trader can be tempted to buy or sell the asset to kind of steer that the price ends up exactly between that desired interval. Notice that the super share is actually equal to a combination of cash or nothing put options. In particular, we can write the super share as a cash or nothing put option with a strike price of K plus Y and a payoff of $1 minus the cash or nothing put option with a strike price of K and again a payoff of $1 and divide the whole thing by Y. By the fundamental theorem of asset pricing, this is equal to the probability that S is between K and K plus Y divided by Y, discounted by the risk-free rate. Okay, this is just taking the expectation over that indicator function. That's just by definition the probability of this event happening under the Q probability measure. If we choose Y to be extremely small, so very close to zero, then the super share approximates also the risk-neutral probability measure Q. To see that, let's take the limit of this whole thing, and indeed just implies what is the probability of S being equal to K. And this again goes back to also the price of an irredeemable security. So we're going to have the super share price multiplied by the return on the risk-free asset is going to be exactly equal to the Q probability that S is equal to K dollars. Notice that this is actually also the same as the approximation of a butterfly spread if in the butterfly spread the three strike prices are converging and going to be exactly equal to each other. Just some final remarks about binary options. So under the Black-Scholes assumption, so if interest rate is constant and volatility is constant, then binary options are very easy to price because they basically just represent a part from a European call or put option. So it is a very familiar formula from the Black-Scholes formula. We know how to do that. Binary options actually turn out to be very difficult to hedge. And the reason is, especially if you get very close to maturity, then the delta is going to jump like crazy between 0 and a very large value. Similar for gamma and vega, these values jump around as you are very close to the strike price K with the underlying asset. Note that American-style binary options are actually exercised as soon as S hits the strike price K, and there is really no reason why you want to wait to maturity. The next thing we look at are package options. Package options are just a portfolio of normal options. So these are really just option strategies like what we have seen earlier in the course. These are like straddles or butterfly spreads or straps, strips, and so forth. Packages can have a negative or 0 or a positive initial payoff and also future payoff. Again, I refer to the chapter where we talked about these different option strategies. Pricing is not very interesting because at the end of the day, it's just going to be a linear combination of standard European put and call options. The next thing are basket options. They are more interesting because basket options are an option written on a basket of underlying assets. So it's not a portfolio of options, but it's an option on a portfolio of underlying assets. They are interesting because we have now many risk sources together in one basket, and the option is written on all that together, and it depends then how these risk sources play together, and we can learn something about this correlation between different underlying assets. Notice that the pricing is quite interesting because the price of a basket option is generally less than the price of a portfolio of options written on all the underlyings in the basket. Why is this the case? Well, let's look at an example. Let's say S is a basket of underlyings, so Wi is the weight on each underlying I, and Si is the price of the underlying I. And the option payoff of a basket option is going to be S minus K or 0, whatever is larger. Now, if you plug in for S, this portfolio of assets, then we can rewrite that as the weighted sum over S minus K or 0. Now, notice that this is going to be smaller than if we take the weighted sum over always the maximum of S minus K over 0. Why is that the case? Well, suppose that for a certain I, S is smaller than K, then on this side over here, we just set this equal to 0, but over here it actually has a negative effect on that entire portfolio as long as some of the other underlying assets have values above K. So pricing is going to be non-trivial, and it's going to depend on how these different underlying assets in the basket actually move together. Therefore, we cannot use the Black-Scholes formula, and we have to resort to Monte Carlo simulations to price these basket options. The value of the basket option is going to depend on the volatility of the entire basket, and that's crucially going to depend on the correlation of the underlying asset, because the volatility of a basket of all the underlying assets is going to be the double sum over all the different asset combinations of these weights on the different assets multiplied times the covariance between assets I and J, where this rho is the correlation between I and J, sigma I is the standard deviation of asset I, and sigma J the standard deviation of asset J. And the smaller the correlation is between the different assets, the smaller is then the volatility of that basket going to be if the weights are positive. A smaller basket volatility at the end of the day makes the basket option cheaper. If we price a basket option, or if you observe a price of a basket option in the market, we can use that to learn about the correlation between the different underlying assets within that basket. The next thing we're going to look at are exchange options. Exchange options allow the long position to exchange the underlying asset 1 for an underlying asset 2. And you're only going to do that if the price of the underlying asset 2 is higher than the price of underlying asset 1. Therefore, the payoff at maturity is going to be the maximum between underlying asset 2 price minus underlying asset 1 price and 0. So this looks actually similar to a European call option, except that you don't have a fixed dollar amount strike price K, but you have actually another underlying asset, which is stochastically changing through time and is potentially correlated with asset 2. This makes things a little bit tricky, but are also interesting because we can learn from these options something about the correlation between these two assets. Now it turns out that if you have a constant interest rate and a constant volatility, so meaning the Black-Scholes assumption, then we can find a closed form solution. In particular, the price of that exchange option is going to be the price of the asset 2 times the probability of that option being in the money under the Q star artificial probability measure minus the price of asset 1 times that probability of the option being in the money, again under that artificial probability measure. The difference between the normal European call option and this exchange option is not just that you replace that present value of strike price by that current price of that asset 1, but also for these threshold values D1 and D2, we have now that ratio between the price of the underlying asset 2 divided now not by the strike price but by asset 1. Now notice that the interest rate disappears because both asset 1 and asset 2 are expected to grow at the risk-free rate under the risk-neutral probability measure Q, and therefore that is going to cancel out. The most interesting thing is that sigma here is not just the volatility of asset 2, but it's actually the volatility of asset 2 minus asset 1, which is the variance of both asset minus 2 times the covariance between asset 1 and asset 2, which means we can learn something about this correlation rho between asset 1 and asset 2. The next thing are min and max options. The min option has a payoff of the minimum between asset 1 and asset 2, which can also be rewritten as the price of asset 2 minus the maximum of asset 2 minus asset 1 or 0. Notice that second part over here, that's again the same thing as the payoff of that exchange option. So in that sense, the min option is a combination of holding a long position in asset 2 minus an exchange option, or in other words, taking a short position in the exchange option. A max option has the payoff of the maximum of security 1 or security 2 price at maturity, and that can be rewritten as the price in security 1 at maturity plus the maximum of security 2 minus security 1 or 0, where again the second part is nothing else but that exchange option. So the max option therefore is a long position in security 1 and a long position in the exchange option. And so therefore the pricing will be just the same as what we have seen for the exchange option. Two-color rainbow options has a payoff of the maximum of either the price of asset 1 or the price of asset 2 or a fixed strike price K. This is actually quite difficult to price because it is not just like in exchange option depending on these two values, and it's not just like in a call option the price of an underlying asset or a constant, but here we actually have to think about a bivariate distribution function between S1 and S2. It turns out that some researchers, Stolz and Rubinstein, they were actually able to find closed form solutions under the Black-Scholes assumption. And again, so when you have a market price on a two-color rainbow option, you can back out again the correlation between asset 1 and asset 2. Quanto option is a type of foreign exchange option. Here you basically write the contract on a foreign asset. Let's suppose, for example, SF is the stock market index in Japan, so the Nikkei 225. And instead of receiving the Nikkei 225 in yen minus a certain strike price in yen, you just exchange that at a fixed exchange rate into US dollar, where typically the fixed exchange rate is just the exchange rate between US dollar and Japanese yen chosen at origination of that Quanto option contract. So what does this mean? Basically, you can get exposure to that foreign market, to here the Nikkei 225, but you don't have to worry about what happens to the exchange rate between Japanese yen and US dollar. Another type of foreign exchange contracts are equity-linked foreign exchange options. And equity-linked foreign exchange options, they also give you exposure to a foreign underlying asset. And here you just get protected against exchange rate changes. So you don't fix the exchange rate as in the Quanto, but you just have a protection if the exchange rate moves too much. And again, we have here a call or a put option written on these exchange rate movements. So you can get full exposure, let's say again, to the Nikkei 225, but you're not protected against downside movements of Nikkei 225 as you did with the Quanto, where you can just say, I don't want to buy the Nikkei 225 if it is too low for the call. Here you have the full exposure to it, but what you're protected is if the Japanese yen and US dollar exchange rate moves against you. You don't fully hedge exchange rate risk, but you can protect yourself against the downside. It turns out that both Quanto and equity-linked foreign exchange options can be priced in closed form, as long as you have again the Black-Scholes assumption of constant interest rate and volatilities. And the interesting part about pricing is that the formula will depend on the correlation between that foreign equity contract or underlying asset and the exchange rate. Compound options are options written on options. So here things become really complicated. So an example of a compound call option that gives you the right to buy for strike price K1 at time T1, another call option which has a future maturity at time T2, which is later than T1, at a strike price K2. Therefore, you're going to exercise that option at time T1 if the price of that call option with maturity at T2, depending right now on the underlying asset at time T1, if that is larger than strike price K1. It turns out that you can find a closed form solution under the Black-Scholes assumption, so constant interest rate and volatility, because under the Black-Scholes assumption we can figure out a closed form solution for the call price at time T1 of that call which you can buy at strike price K1. But this formula is actually quite complicated. I state it over here and explain what these different terms mean. And I then also state these threshold values A1, A2, B1, and B2. If you are interested in looking at that solution, you can read through these slides here and figure out exactly how this works. Next, we look at the choose as you like it option. This is really an option for someone who isn't really decided whether he wants to buy a put or a call option. So in particular, at time T1, the maturity date of the choose as you like it option, you get to choose whether you want to have a call option or a put option at time T1, and both of these options have a maturity date at time T2 further in the future. Now you're gonna take the one which has the higher value. That's why the payoff of the choose as you like it option is just the maximum between call or put price. Now if the call and the put options both have the same strike price, then we can actually rewrite the put price by the put call parity as a call price plus borrowing some money and short selling a underlying asset. This is useful to do because now we can factor out the price of the call option at time T1 with a maturity at time T2. And so what we have now is just that current price of that call option with the maturity at time T2 plus something which looks exactly like the payoff of a put option with maturity at time T1, where that put option has a strike price given by this thing over here. So therefore, the choose as you like it option has a current price which is equal to a call option with a strike price K and maturity at time T2 plus the current price of a put option at time small t with maturity date at time T1 and the strike price given by this dollar amount. The next thing are exotic options which are path dependent. Path dependent means that the payoff of the option at the maturity date does not only depend on the current value of the underlying asset at the maturity date, but it depends on the entire path of the underlying asset during the lifetime of the option. So it depends on all the prices which we observe between small t and capital T, and then potentially it also may depend on interest rates and some other state variables which might be macroeconomic variables or something else. Now, by the fundamental theorem of asset pricing, the price of that option at time t is going to be as before, the payoff of that option at the maturity date discounted by the risk-free rate and taking the expectation under the risk-neutral probability measure Q. Now, under Black-Scholes assumptions, sometimes a path-dependent option can actually be priced in closed form. So again, if interest rate and volatility are constant, but then for some other more complicated options, that may not be possible, and you need to resort to Monte Carlo simulations to approximate the FDAP expectation, or also if you assume that interest rates are not constant or volatilities are not constant, then you need to resort to Monte Carlo simulations. First thing we're going to look at are barrier options, and barrier options depend on whether the price of the underlying asset hits a certain barrier value during the lifetime of the option. The first one is the up and in or knock-in option. It can be a call or a put option, and these options are worthless unless the price of the underlying asset is crossing the barrier L from below during the lifetime of the option. So the option is in effect becoming a European call or a put option, but only if the price of the underlying first crosses the barrier L from below. The down and in or knock-in option, which again can be a call or a put option, is worthless unless S hits the barrier L from above. So meaning again, you have a standard call or put option, but only if the price of the underlying asset first crosses the barrier value L from above. Now the up and out or knockout option, which can be again a call or a put option, that thing exists as long as S does not hit the barrier from below. So meaning that it will be worthless if S hits the barrier L from below. And the down and out or knockout option, which again can be a call or a put, this one expires and is worthless if S hits the barrier L from above during the lifetime of the option. Barrier options are cheaper than equivalent options which do not have that barrier property built in, and therefore barrier options are popular in structured products because again they don't cost as much. Moreover, if you're the writer of a barrier option, this can actually be more desirable than writing another option if the market for options is quite illiquid. So the example over here is quite illustrative. So suppose you write an option, so meaning you take a short position in a call option, and let's suppose that you have a covered position, so you have a long position in the underlying asset. Now let's say if the underlying asset price falls and the option writer has to sell the underlying asset due to some liquidity reasons, but maybe it doesn't have anything to do with actually taking the short position in that call option, then maybe that option writer may want to buy back a call option to basically cancel out his short position in the call option. Now, the problem might be that this option market might be very illiquid and buying back the call option is very difficult or might be excessively expensive, and therefore having here written a down and out barrier option might be a great alternative, because if I'm the writer of the down and out barrier option, I actually don't have to worry anymore, because if the price of the underlying asset drops sufficiently, then the down and out barrier option will be worthless. Okay, and I don't have to worry about covering my position anymore. You can actually derive closed form solutions for barrier options under the Black-Scholes assumptions, so under constant interest rate and constant volatility. Look back or no regret options, these have a payoff which depends on the difference between the underlying price and either the maximum or the minimum price of the underlying asset during the lifetime of the option. So a look back call option has a payoff of the current price of underlying asset minus the minimum price during the lifetime of the option, the minimum price of that underlying asset. So the strike price is just the minimum price of the underlying asset. The look back put option has a payoff of the maximum price of the underlying asset during the lifetime of the option minus the price of the underlying asset at maturity. Now, of course, this minimum and this maximum will crucially depend on how often we actually sample the stock prices to calculate the minimum and the maximum. So if you, let's say you have 1 year lifetime of the option, 1 year left to maturity, and let's say you only look once every week at the price of the underlying asset, and you then take just the minimum or the maximum over these 52 weekly prices, there the minimum and the maximum will be less extreme than if you look, for example, every day at that underlying asset price and then choose the minimum or the maximum. So in the option contract, it should be specified what the sample frequency is for calculating this minimum and this maximum. And if it is daily, it should say what time of the day you want to look at the stock prices. The closing price, is it the open price, or is it the price, for example, at noon? It may change your result. Closed form solutions can be derived for the look back or no regret options under the Black-Scholes assumption if interest rate and volatility are constant through time. Asian options. These are also quite difficult to price. An Asian option with a fixed strike price, a call option, has a payoff of the average price of the underlying asset during the lifetime of the option minus the fixed strike price or zero. Here you actually have to again keep track of the price of the underlying asset during the lifetime of the option to compute that average price. For the fixed strike price Asian put option, you get either the strike price minus the average price of the underlying asset or zero. For a floating strike Asian call option, that will have a payoff of the price of the underlying asset at maturity minus some constant, which is often set equal to 1, times the average price of the underlying asset during the lifetime of the option, or 0. And then lastly, the floating strike Asian put option that has a payoff of a constant multiple times the average price of the underlying asset during the lifetime of the option minus the price of the underlying asset at maturity, or 0. Now notice that it's really important how we define how to calculate that average price of that underlying asset during the lifetime of the option. And there are a few considerations which we have to make. The first one is, do we look at an arithmetic or a geometric average? Then do we calculate the average during the entire lifetime of the option or only during a certain part of the lifetime of the option? Moreover, the question is, do we equally weight the stock prices during the lifetime of the option, or do we have a certain non-equal weighting scheme? And then of course it's again important, what is the sampling frequency? Do we only look at, let's say, the price once a week on every Friday during a certain point of time of Friday, or do we look at daily prices, or do we look at hourly prices, or how do we choose this frequency? That will again affect that average quite a lot. Closed form solutions can be derived on the Black-Scholes setting if interest rate and volatility are constant, as long as you compute the average price by a geometric average. Asian options are actually quite suitable if markets of the underlying assets are not very liquid, and if you can have very large price movements in the underlying asset and you're worried that the price at the maturity date might be just for some reason because one guy was trading just a big position, may be quite different than what the actual fundamental of that underlying price should be. And so if you're worried about that the price of the underlying asset may temporarily deviate from its fundamental, then it might be more attractive to say, look, instead of looking just at the price of the underlying asset at maturity, we want to look at an average price of that underlying asset during the lifetime of the option. Notice that this argument only applies for the fixed strike Asian call or put options, because again, for the floating strike prices, the payoff is going to depend on the underlying asset price at the maturity date. The last type of exotic path-dependent options are mountain range options. These are combinations of barrier and basket options. The altiplano option entitles the buyer or the holder of that option to a fixed payout if no stock in a basket hits a certain barrier during the lifetime of the option. If a barrier is hit of any of these stocks in that basket, then the option holder just gets a plain vanilla or an Asian call option on the entire basket. So this thing is quite tricky. This already sounds like a complicated structured product because you have to consider many different events. So first of all, you have to keep track of many stocks which are in that basket, and you have to figure out whether any of these stocks hits the barrier or not. If it doesn't happen, well, then you get a fixed cash flow, which you can just discount by risk-free rate. But if it does happen, then you actually have to price a standard option or an Asian option written on a basket of stocks, which again is not quite a simple thing to do. The Annapurna option gives the holder of the option a payoff as long as none of the stocks in the basket fell below a certain fraction of its initial value during the entire lifetime of the option. So here it's basically a speculation that none of the stocks in that basket depreciates sufficiently. The Atlas option removes for the final payoff of the option some of the best and some of the worst performance, and then it's just an option of the basket of the remaining underlying assets. The Everest option gives the option holder a payoff of the worst performing member of a large basket of stocks. And so typically the Everest option is a long-term maturity, about 10 years or more, and has a basket of many stocks, so might be like 10 or even 25 stocks. For the Himalayan option, there are given dates, and at each of these dates, you look at the performance of all the stocks in a basket, and you're going to record the performance of the best performing stock, and then you remove that from the basket. And then you keep going to the next date, you figure out again the performance of all the stocks in that basket, you record the one of the best performer, then you remove it from the basket, and then you continue until to the maturity date. And at the maturity date, then the payoff will depend on the sum over all the recorded period returns during that lifetime of the option. So the sum of all these best performer stocks returns at these given dates when you have recorded these returns. Mountain range options are quite complicated, and in most cases you do have to solve them with some Monte Carlo simulation or some other numerical procedures.